Welcome to Yahoo Finance's special coverage of the January CPI report. I'm Shauna Smith alongside Brad Smith, and the key inflation print crossing the wires right now. You're looking at CPI on a year-over-year basis. The headline number coming in at 3%, slightly hotter than expected. On a month-over-month basis, CPI coming in with a rise of 0.5%, much hotter than what the street was looking for. They were looking for a rise of 0.3%. When you take a look at the core number, stripping out food and energy on a month-over-month basis, you're looking at a rise of 0.4%, again hotter than what the street was looking for here. And then that year-over-year number coming in, core CPI coming in at 3.3% rise, hotter than what the street was expecting, also a bit above of what we saw last month, with that reading coming in at 3.2%. So hot prints here across the board. Brad, when you take a look at the stock's reaction here this morning, you are looking at all three of the major averages on track here to open the day in negative territory here as we do react to the CPI print. Of course, questions as to what this ultimately means here for the Fed going forward. Obviously, a hotter than expected inflation print could potentially call into question. Maybe at some point we could start talking about rate hikes again. Obviously, a little bit too early. This is just one print. But again, when you take a look at the fact that inflation coming in hotter than expected, this, of course, is a bit alarming, at least to the street at first glance.
Yeah, I'm taking a look at some of the futures activity as well here, as we're taking a look at the declines across the board for the Dow, the S&P 500, and the NASDAQ. Fractionally as they may be, they are down, all of them, by about 0.8% here. And I'm looking into some of the indexes here as well. About 30% of the increase that we had seen in the CPI report attributed to shelter. That rose 0.4% in January, accounting for nearly 30% of the monthly all items increase, according to the Bureau of Labor Statistics. And then looking at some of where inflation did continue to move higher versus where it did decrease, indexes where we saw it actually rise, index for ultimately taking a look at the index for motor vehicle insurance, recreation, used cars and trucks, medical care, communication, and airline fares. Those were among the indexes that increased during the month over the month. However, the indexes for apparel, personal care, household furnishings, and operations were among the few major indexes that did decrease during January here. And so this is, we're continuing to really price in, and perhaps there's some people out there doing a Command F, Control F, depending upon what type of operating system you're using for the price of eggs. Well, guess what? For meats, poultry, fish, and eggs, that rose 1.9% over the month as the index for eggs increased, get this, 15.2%.
All right, well, let's talk about this hotter than expected inflation print. For that, we want to bring in Claudia Sahm. She's a former Federal Reserve board economist and the chief economist at New Century Advisors. We're also joined by Leslie Falconio, UBS Global Wealth Management, head of taxable fixed income strategy. Great to have both of you here this morning. Claudia, let me start with you. This slightly hotter than expected print. What do you think?
Yeah, there's no sugarcoating this. This is not a good print. The one thing to say is this is a familiar disappointment. We have seen January effects that have been, upside surprises, hotter prints at the beginning of the year. Some of that looks like just the resetting that happens at the beginning of the year. We've got some more price pressure. It's pushing in there. So again, having a hot print in January in recent years has been a common occurrence, and it's also been a common occurrence that's dissipated as the year's gone on. So this isn't a deal breaker for the year as a whole, but it is certainly not a good way to start things off. Yeah,
not a good way to start things off indeed here. Of course, as we're continuing to think, Leslie, just about more broadly what this means for traders as we're seeing some of the reaction here this morning, I wonder what type of thought gets initiated off the back of a report like this for you.
Well, listen, the market was already pricing out most of the Fed cuts even prior to this report because, what we're hearing from tariffs, it's a typical, move in the market where inflation expectations rise in the short end, the 2-year goes up, they take out these cuts. So the market's really only had about 30 basis points of cuts priced in for 2025 prior to the number. But, I do agree that, January is always a bit higher. Our expectation was it would become higher than consensus, nowhere near where this print is. But we still feel over the course of the year, things like, OER will trend lower. I mean, you can have, a couple of dents in disinflation, but we don't think it's going to be completely derailed.
Claudia, when you take a look at what the Fed's likely move is going to be, obviously staying on the sidelines, talk about the fact that they have been very, very data dependent. Does this push out that timeline even longer at this point for the next potential rate cut? And should we even be talking about the potential here for a rate hike at some point?
Well, first of all, the Fed is never going to overreact to 1 month of data, right? So we learned something today, but this isn't everything. Now, they've been telling us since December that they're in no hurry to adjust rates again. And that will be reinforced today. Like they're really in no hurry at this point in terms of adjusting rates. So they've told us they're going to go slowly. This clearly does not put them, on a track to rethink that. So I mean, we're looking for several months, and we're back in the case of last year where we're going to have to see months and months getting out of the first quarter of better inflation data before the Fed gets comfortable with it. So that really does push the timeline probably into the second half of the year if things go well, right? If this ends up being the outlier.
Leslie, what do you think? Do you agree with Claudia?
I do. I mean, we've had 2 cuts priced in for 2025, June and September. Maybe after this number, we might reassess, but highly unlikely. I mean, as Claudia mentioned, it's a 1 month number. It does have a tendency to, be on the higher side. So, we're definitely going to reassess, but our view was the Fed was going to be on hold, and the markets, remember, the market's pricing all this in already, right? The market already took out a tremendous amount of cuts back in the December meeting. So it's not as though the market was thinking that the Fed was going to cut 100 basis points this year. They only had 1 cut in the second half of the year. We still have 2 in June and September. Right now we're not going to change that path, but I think that the market is actually a little bit on the hawkish side right now. And 1 number doesn't necessarily alter the path, but we have a lot of influences and a lot of data that we still need to see besides just policy uncertainty.
And so within that policy uncertainty, Claudia, we've all been discussing at length and for some ad nauseum because of that policy that largely has focused and centered around what tariffs could potentially be inflationary as well. At what point would you expect that to start showing up in prints, and to what extent?
So the effects of these policies are going to matter so much on the details. And right now we have more uncertainty and chaos than we have details. So it's really hard to know where these are going to show up. But, we can have already anticipatory effects. It's clear from some of the consumer surveys that tariffs have gotten people's attention. If they're out buying, putting pressure on goods prices, it could put a little bit of lift on some of those prices. And then otherwise, as tariffs go into place, it'll take time to come through the pipeline. But really, we're just at the beginning of understanding what those policies are, and probably it's going to be months before it shows up in the data. But even before the tariffs happen, they can affect people and businesses' behavior ahead of time, which can really make it hard to get a read on, like, the underlying, like, what's happening with inflation in the economy.
Claudia, from the readings that you are getting, I guess how much more progress do you expect to see on inflation this year?
I think we're on a path to have continued disinflation. I mean, we're not that far from the Fed's target, right? We're moving in the right direction, but we do have the benefit of the labor market is very good. Consumer spending has been very strong. That probably does slow the disinflation some, but it also gives us time to get real wages up and, make up for past inflation. So I think we could be very much on a track for, like, the underlying disinflation that looks a lot like last year. Some progress, not that much, but some, which is what we need. But then the real wild card are these other economic policies that could, if nothing else, temporarily push up inflation. So, like, this year is going to be pretty messy probably on the path of inflation.
With that in mind, as we're continuing to track this, Leslie, you said that you're leaning towards higher quality sectors. You're looking at the 5-year Treasury, looking at investment grade corporates, agency, mortgage-backed securities, prefer loans over high yield. Within that, kind of what is the portfolio mix that investors should really be leaning into, as it seems like there's more of a defensive mindset that's prevailing right now and hedging against some of the potential volatility risks?
Well, I mean, listen, first off, just to state the obvious, you have to be diversified, right? Particularly with all this uncertainty. I mean, we're staying with the higher quality sectors like investment grade corporates and, 5-year Treasury, simply because we just don't feel like you're paid enough risk premium to go into high yield. Not that we think you're going to have some sort of catalyst, but, the high yield market has done, incredibly well. The volatility in these spreads and lower credit quality spreads have been almost nil for several months because there's a lot of demand. There's no question. There's a technical tailwind there. The fundamentals and corporate balance sheets are very strong. There's not enough risk premium now to go into these really lower quality sectors. So we're staying with the higher quality, like investment grade corporates, 5-year treasuries. But we also have that bit of a diversification on that we're on the loan market, right, which is floating rate. Our expectation, particularly after the December FOMC meeting, that the high for longer was probably going to stay in place. So we have no problem putting part of our portfolio into that floating rate sector as part of that diversification. With that said, our expectation remains that by the end of the year, we're looking at we believe anyway the 10-year yield is going to be around 4.25. I mean, the market reacts initially to this inflation reacceleration. It's done it since December, and then kind of particularly with potential policy implementation, the slower growth impact kind of comes in, and that's why we think the Fed cuts, and we kind of bull steepen in the latter part, the second half.
Claudia, Leslie, thank you both so much for joining us here after the CPI print this morning.
Thank you.
Let's send it on over now to our Jared Blikre for a look at the movers on the back of this January CPI report. Hey, Jared.
Hey, Brad, it is risk off here, and we are being led down by the small cap futures, and you can see this in behind me in the upper left. Russell 2000 down almost 2%. This is the overnight chart since midnight, and you can see we were in the green and just took a strong leg lower on the back end of that report. That surprise to the upside, which, by the way, the headline number, haven't seen something surprise that big since, I believe, 2023. You'd have to go back to August of that year. The Dow, the S&P 500, and the NASDAQ futures, all of those are in the red, and we have treasury yields screaming higher right now, but these are the futures, so these move opposite yields. And the 2-year treasury note is moving down, and the 10-year is moving down even more strongly. What does that translate into in terms of yields? That's about 8 basis points to the upside, and that's a pretty strong move. We have seen higher yields recently this year, but once we start getting back up to 4.75%, that is a pain point. That is a proven pain point for the market. Here are gold futures, not too much of a reaction off of the news that we're looking at right there, but I did track some movement in the dollar. Here's the euro versus the dollar. Euro sinking on the news means the dollar is gaining. That is the wrong direction for risk assets overall, but it's not a big move just yet. And then finally, the risk arbiter of choice here, that is Bitcoin. Bitcoin down 3% right now. It had been up, and so that's an even bigger swing. You can see it was about 96,000 and a half, and now it's trading 94,000, so about $2,000 to the downside for Bitcoin on the back end of this report. And a lot of times, I'll just close by saying this as we look at some of the sector action. A lot of times we do get a reversal in the first 30 minutes, first hour of trading. So that's 9:30 to 10:30 a.m. Eastern time. We could see an upside surprise. We've seen big reversals off of negative CPI prints or bearish CPI prints before. And that's kind of the hallmark of a bull market, being able to shrug off these things. So what matters today is the close. But as you can see in these little rectangles down here, that's a lot of red. Right now we're being led down by utilities and real estate, and that's interest rate sensitive right there, guys.
Certainly makes sense here in this risk off a trading action. All right, Jared, thanks so much. Coming up, we will have more on the January CPI report and a look at what categories saw the largest price changes. We've got that for you next on Yahoo Finance.
Bonds and stocks selling off following the January CPI report. Treasury yields jumping after CPI comes in hotter than expected, rising 0.5% month over month and 3% from a year ago. We have Dennis Gartman, who's the former editor and publisher of the Gartman Letter and chairman of the University of Akron's Endowment Committee. Great to have you here with us this morning. I want to get your read through, especially as it does relate to some of your own calls that you've been looking at across the different asset types outside of equities and the reaction that we're seeing in yields this morning.
Well, first of all, I trade only from my own account. I do have some administrative circumstances required with the University of Akron, where I'm the emeritus chairman, not the chairman. They aged me out of being a voting member, and I'm now the emeritus chairman. But I am marginally net short of the bond market, marginally net short of stocks. And never underestimate the importance of being lucky. I was very bullish of gold for a long period of time and got out of my gold positions the other day. Again, never underestimate the importance of being fortunate or lucky in the realm of trading. I think this morning's CPI number was quite a shock, to be blunt. I thought it might be up 0.4%, we have to remember that January is always a market or a number that tends to be revised rather dramatically, but it's catching everybody off guard this morning, and it's put tremendous pressure on stock prices, tremendous pressure on the bond market. And what's interesting is the gold market is falling rather precipitously at the same time. So it's an interesting day. It'll be interesting to see what happens during the course of the day. As the gentleman just before me said, there tends to be there's a marked tendency for the market to respond bullishly after the numbers come out in January. We shall see whether that happens again today or not, but I have my doubts. I think that I've been very bearish with stocks for a while, and I continue to be bearish with the stock market. I think today is going to put downward pressure for a protracted period of time.
How much downward pressure, Dennis?
I think we take stocks down 10 to 15% from their highs that were seen about a month ago. So let's just say that that's a reasonable expectation over the course of the next several weeks or months.
And so if we do see that type of move, what do you think happens across other asset classes as well? Do people flock to some of the safe havens? And especially as you were just talking about gold, it brings up the thought about how you're thinking about other commodities right now, too.
I have been bullish of the grain market for a while. But I think after this point, we've had a rather substantive rally in corn. I think that's probably run its course. The only commodity that I find to be relatively cheap is cotton. There's going to be very little cotton grown this year. 68-cent cotton is extremely inexpensive, but that doesn't mean one goes out and buys cotton at this point. The term structure has not yet been turned bullish. And I watch the term structures in most commodities. Pay attention to what's going on in the term structure in crude oil. That continues to be quite bearish. And I think crude oil wants to go into the 60s before it's done.
Dennis, when you take a look at the bond market reaction here this morning, and when you take a look at the dramatic move higher that we are seeing in the 10-year yield, I think the big question investors are asking how much higher we could see yields drift from here. Here we are at 463. Are we talking 4.7? Are we talking 4.8? And then that, of course, would potentially add even more pressure and kind of fall into your thesis just on some of that downward risk that we could see in the equity market.
I think it's going to be hard to get the 10-year beyond 4.85%. It'll probably get there, but I think it'll be difficult to push it beyond that. The target of 5%, I think, is out of the question as far as I'm concerned. Time shall tell. But
why,
I think
Dennis? Why
is about as high as it can go.
Why is 5% out of the question?
That's just such a magic number. We'll see what happens when it gets towards 5%. But I think right now, thinking that it gets to 4.85 is enough. We'll see what the trend of the market is at the time, what the news of the market is at the time. But I think 5% will probably, the operative word here being probably, be enough to keep the rates from moving much beyond that. I think time shall tell.
Dennis, it seems like the news of the market has been how to play or factor in or try to look far out into the future enough to evaluate the impact of tariffs and what that would eventually mean as a read-through to some of the economic data, to the extent that we actually see that start to transpire. What is your calculus there?
To me, the future is next Tuesday. That's about as far out as I'm able to look for any period of time. That's a little too flippant. To me, a month or two is about as far as one can look. Things can change rather dramatically over the course of 2 months. So right now, the trend, to me, the trend of stocks is down. The trend of commodity prices has been from the lower left to the upper right, but I think most of those are probably have been discounted. The only thing that I'm interested in is cotton, and I'm interested in being short of crude oil. And I'm a long-term bull on the gold market. I'm out of gold completely at this point. But if we take gold down another $50 to $75 an ounce, I'll be back to being a bull on the gold market.
Dennis, what do you
think? But again, I look till Tuesday of next week is about as far as I'm capable of looking forward.
Dennis, what do you think will add some of that more extended selling pressure that you are expected to see on gold? What's going to trigger that beyond even a move like today?
I think people misunderstand what tariffs mean. Tariffs are specific to, as far as inflation is concerned, tariffs are specific to the commodity that is being investigated, but tariffs are actually deflationary in the long run, because unless the monetary authorities monetize the increase in price from the tariffs that are put into effect, other commodity prices have to go down in value. So I think people forget that fact and misunderstand tariffs. Tariffs are inflationarily specific, but not inflationarily generic. And I think people have to understand that fact. They have paid attention to the gold market in the course of the past month and a half, and the boat got a little bit too crowded as far as I was concerned. Too many people got bullish of gold. I'll be bullish of gold again when we fall rather sharply over the course of the next 2 or 3 weeks.
All right, Dennis Gartman, always great to get your insight. We look forward to continuing the conversation sometime soon. Thanks so much.
Thanks for having me on. Always an honor.
A quick recap of the January CPI print coming in hotter than expected, up 0.5% on a month-over-month basis and 3% on a year-over-year basis. When you take a look at those numbers, obviously hotter than what the street was looking for here. The question is what this ultimately means for the Fed, just given some of those inflationary pressures that we are seeing. But again, the CPI print coming in a year-over-year up just about 3% hotter than what the street was looking for. Let's talk about where we are seeing some of those pricing pressures. For that, we want to bring in Alexandra, Canal, and Madison Mills joining us here at the desk. And Ali, when you take a look at some of the pricing action that we have seen over the last month, it's a pretty familiar report to what we've seen in the past.
Yeah, but much different from what we saw last month, right? There was a lot of encouragement that we saw a deceleration in core CPI, much different story this time around. And if we take a look at the headline figure, there were certain seasonal factors that pushed that higher fuel costs, continued stickiness in food inflation, egg prices, a notable standout here, increasing 15.2%, the largest increase since June 2015. It accounted for about 2/3 of the total monthly food at home increase, according to the BLS. So that's something that a lot of economists are going to be discussing today. I mentioned those core prices that strips out the more volatile cost of food and energy. Now they, again, across the board on a month-over-month basis and an annual basis, came in hotter than expected. Now within core, we did see some more encouraging signs when we think about shelter, for example. That rose 4.4% on an annual basis, which was the smallest 12-month increase in 3 years. Shelter has been something that the Fed has been very focused on. It's been a very difficult area of the economy to bring prices down. So the fact that we are seeing that deceleration over an annual basis is encouraging. However, if you think about something like used car prices, which we've been consistently talking about, another strong uptick for the 4th consecutive month, rising 2.2% in January after a 1.2% increase in December and a 2% monthly gain in November. So all of this contributing to the sell-off that we're seeing in stocks. And then, of course, we're seeing traders scale back expectations.
Yeah, and Ali, it's not a familiar report because a lot of the stickiness that we are seeing is what we have seen in the past.
Exactly.
So I think the big question here for investors, as we talk about some of that expected improvement or maybe what we want to see before year end, where is that going to come from? I guess how optimistic or pessimistic are they on the heels of a print like this, just given some of those inflationary
I think it comes from the areas of the economy that affect consumers the most.
Yeah.
The food, the rent, the shelter. This has been what's been pressuring the consumer over the past year, and we're not seeing any significant relief. Rent inflation continues to be high. You talk about egg prices all over the country. Grocery stores are now limiting the amount of eggs you can even purchase. So all of that, I think, is what we're going to have to see continue to come down.
And Maddie, I mean, what a 24 hours for you. Yesterday, you were watching Cowboy Carter tickets. Today, you're watching CPI. What are you keeping tabs on with this?
Experiencing that consumer inflation firsthand with that ticket purchase. But I think you bring up a really good point, Ali, on the impact to the consumer, and something that I know we would love to hear is that maybe this inflation is just seasonality. Maybe the data for January is going to be too hot across the board and it's not something too sinister. So I took a look at the inflation data from January of last year and compared it to this year. January of 2024 also came in hot. You can see on your screen there at 3.1%. And inflation was hotter throughout the beginning of 2024 compared to what we saw throughout the rest of the year. So do we just tend to get hotter inflationary pressures in the beginning of the year? An analyst noting to me this morning that categories like lodging, airlines, those tend to be volatile numbers. So perhaps that led to a hotter than expected print this morning, which doesn't necessarily have something more sinister under the hood here. But that brings me to that sinister argument. I really quickly, guys, want a little bit more time here to pull up that super services number, up 0.76% month over month, the highest level since last year here. That is a bad sign for the Fed because they've been trying to tackle services inflation in lieu of being able to tackle goods inflation because companies just aren't going to cut prices once consumers get used to spending a certain amount. If the Fed cannot control services inflation, that is going to be a significant headwind for them moving forward.
Ali, Maddie, thanks for breaking this down further. We've got much more ahead on Yahoo Finance.